Hey everyone, and welcome to Talk ETFs. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Tim Huver, who's Managing Director at Brown Brothers Harriman. Tim, great to have you on the show.
Great to be here. Thanks for having me.
Absolutely. So, Tim, you guys recently released your Global ETF Investor Survey. For those in the audience who aren't familiar with this, can you tell us a little bit about what this survey is and what it's supposed to measure?
Yeah, sure. So this is the 12th annual BBH Global ETF Investor Survey. It's become a really well-read, well-referenced piece of research in the ETF industry. Each year, we poll professional buyers of ETFs, so institutions, asset managers, wealth managers, to really understand the product preferences, the evolving ETF usage within a portfolio, emerging asset classes, and themes and trends that we're seeing within the ETF industry across the US, Europe, and Asia. This year, the majority of investors managed over $1 billion in assets. And so it's a very sophisticated audience. And one of the other changes to the survey this year, we wanted to really understand the why behind the buy. We've seen obviously increased adoption of ETFs. Everybody sees the growth, but what's shaping that growth and how are product decisions being made? And so we've incorporated more of those types of questions to help with the interpretation of the overall results.
And that's a great segue to my next question, Tim. You mentioned, the growth of ETFs. One thing that stood out to me, 95% of investors plan to boost ETF allocations this year. Can you talk about what is driving that growth?
Yeah, it was an incredibly high number. We are also seeing that 73% of professional investors looking to expand the number of sponsors and issuers that they're working with. So not only just demand for ETFs, but demand for, I think, a larger number of ETF sponsors in the marketplace. I think the ETF features play prominently in terms of the popularity. So if we talk about the tax efficiency of ETFs specific to the US versus other vehicles, the trading flexibility, the liquidity, especially in these volatile markets, ETFs tend to lead price discovery, tend to provide a real-time snapshot and transparency into what's happening in the underlying markets. They're a very efficient way to access maybe harder to reach markets as well. So I think those factors play prominently in the investment decision. We saw versatility in the ETF wrapper, almost an equal number of respondents using ETFs in a strategic, long-term type of fashion, with investors on the other side, an equal number using ETFs in a more tactical, maybe tilt to the portfolio. So I think the versatility of ETFs and then being a factor. And then finally, I will just say the current market environment, and we gauged market sentiment, investors concerned about interest rates, about trade policy globally, about inflation. And with that, investors looking for innovative solutions in the ETF space to help manage that volatility and to manage risk through that period of time. That was not only traditional asset classes like fixed income, but also alternative investments. We heard demand for moving more towards the ETF wrapper, defined outcome or buffer strategies that provide that downside risk protection. So structured products moving into the ETF wrapper. And then finally, active management and more investors seeking active managers in this market environment.
Yeah, Tim, that really struck me as well. The demand for active ETFs. For the longest time, ETFs were kind of synonymous with index investing, but that's no longer the case. And your survey suggests that many investors are looking towards active ETFs. What do you think is driving that growth?
I think when we look at the numbers, a few interesting findings there. We're certainly seeing the growth in the cash flow numbers. So no longer just the data point that active is popular. Now we're seeing, I think, an inflection point where we're seeing assets move towards active ETFs. And we asked professional investors, when they look out over the next 12 months, where do they anticipate allocating capital from when funding an active ETF? And we heard that over a third of investors are looking at reallocating from passive management, whether that's ETFs or index funds, to active. And I think there's something about the current market environment where investors are looking for institutional quality, best-in-class active managers to really help navigate these markets, moving away from maybe a broad-based approach and looking at active managers that can help provide outperformance and alpha within the current market environment specifically. So that was, I think, an interesting finding when we look at where some of that cash flow will move from over the next 12 months.
Tim, I know in your survey you asked a bunch of questions about crypto. This was obviously a huge theme in ETFs in 2024. What is your survey saying in terms of crypto adoption? Are more and more investors looking to invest in things like spot Bitcoin ETFs?
In terms of the findings, another interesting finding here, I think when you look at crypto and the performance, we've been following that over the past decade, really strong performance. Investors also thought that the asset class, crypto, would be one of the top performing asset classes over the next 12 months. I think what's interesting, often, and I think historically, we've assigned or attributed some of the cash flow, some of the adoption to more of the retail investor market. But the demand over the next 12 months through our findings would lead us to believe that it's actually institutional investors gravitating towards crypto, towards digital currency. 76% of institutions plan to increase their allocation to crypto investment. So I think we're seeing mainstream adoption, mainstream just overall acceptance of crypto. I think as time goes on and there's a longer track record, we'll understand how crypto reacts through different market cycles, through inflationary periods. Does it provide an uncorrelated asset class? And so I think we're getting more and more data points there to validate the investment case. But in terms of adoption, we are seeing acceptance and adoption, and we expect that to continue in the next year.
Another really interesting stat that I saw in the survey is 31% of firms are now using AI-driven tools for investment decisions. How are they using these tools, and how do you think AI in general is going to change the investment landscape, Tim?
So this was a shift. In the past, we would look at AI as almost an investment theme and looked at the popularity of that category, which was strong. This year, we wanted to understand how professional investors were using that within their investment process and within the decision-making process. And so what we found was 87% said that they are using AI in some way, shape, or form, whether that was for research, due diligence, or even going as far as making investment decisions or really driving the investment decisions. So interesting takeaway there, I believe, in terms of where AI, and maybe still early days, but where AI may be moving towards in terms of overall due diligence, product selection, and research.
Absolutely. And final question, Tim, when I first started in the ETF industry, expense ratios were the number one thing investors looked at when deciding what fund to buy. Based on this survey, that doesn't necessarily seem to be the case anymore. Only 30% rank expense ratios as one of the top three considerations. Is that right? And if it is, what factors are investors focusing on when selecting ETFs?
Yeah, this one surprised us as well this year. If you look back as recently as 3 years ago, expense ratio was a top three criteria within the product selection process for investors. This has dropped down to the bottom of the list. And so when we look at that, I think as investors have moved away from core beta, broad-based exposures, are looking at the innovation in the marketplace, are looking at accessing new asset classes, alternatives, more product solutions that are very surgical in terms of what they offer. And we talked about, best-in-class managers and the ETF being able to provide that. As they're moving towards those types of investment themes, the data and the research would show that they're placing a premium on the value added through those categories and through those products. And so we did see cost moving close to the bottom of the list there. If you look at some of the factors that are being considered, brand consistently appears towards the top of the list in terms of a factor or variable that's considered. We also test within the survey what creates that brand, what creates that trust with those sponsors that you work with. We hear market research, analysis, educational support. That was consistent across markets as well. Some regional differences. Europe, they look at trading and liquidity, investors there more closely. I think that's indicative of the market being somewhat more fragmented in terms of the number of exchanges, the number of different currencies that a single ETF may be listed in. And so therefore that fragmentation, putting trading costs and liquidity top of mind when investors are considering the total cost of ownership for an ETF. So some market nuance based on infrastructure across regions, but still brand scoring very high, and cost, as mentioned before, being lower on the list this year, which is an interesting finding.
Great stuff. Well, Tim, where can people go if they want to see this full survey and they want to learn more about it?
Yes, so full results and findings published out on bbh.com. So please do reference the survey there. This is just scratching the surface in terms of the data, the analytics, and the findings that we have published.
Fantastic. Well, a ton of great insights, Tim. I want to thank you for your time.
No, always appreciate it. Thank you, Sumit.